Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, August 11, 2022. It is 2:28 p.m. Eastern Time. I'm starting the video, so we've got about an hour and a half to go before the markets close today. And what I'll do is a quick update on the equity markets along with some of the other trade ideas I've been highlighting lately. I'm going to talk about commodities quickly, and really that whole positive feedback loop that I've been talking about between the Feds, the markets, commodities, inflation. It's all interrelated, and so let's just dive in here. This is QQQ 60-minute chart. You've got your primary downtrend line off the highs there. That was the second peak, the lower peak right there, right around the time the S&P 500 topped. Has been and remains my the bottom of my max bounce target range. Remember back here from pivoting on the lows, closing all shorts, going to longs on June 16th, and so that's it. That was the the downtrend line off the highs there. You've got the 200-day exponential moving average, and then up top, and I give you a little box here to kind of show you the range. You have the 200-day simple. Both of them, the exponential and simple, came in together on that first bear market rally back there, and that's what capped it. And the next time around, it was the simple. But I leave the exponential up, and quite often the tech-heavy indexes and market-leading stocks will react off that 200 exponential. Does a great job for QQQ over, historically. So, you can hold out, and maybe we'll hit the 200. Who knows? Maybe we go through the 200 simple. But this is where I maintain, it's objective to add on shorts or take new shorts, get out of longs, whatever. And so that's it. And by the way, the from today's highs, that 200 simple is only about another 3.5% or so higher. About 3.5 is where it'll come in when we get there. And of course, there's no guarantees we can't go on through there, but we're getting stretched here. And again, the 60-minute charts show you have the negative divergence. There's our negative divergence right there on the indicators, making lower highs with prices making a higher high. Price resistance, 200-day, everything I showed you. There are no guarantees, but it doesn't get much better than that. And remember, this was the chart I gave you this morning was right here, showing you we're right at it. And then, even what was this, the 8th, whatever that was, a few days ago. That was the last time I posted the screenshot of this chart, and that's what it said. QQQ continues to offer an objective short entry here, and we're up to the primary downtrend line and 330 resistance level following the breakout. So that's the scenario that so far played out. And then let's just zoom back into today and go short term and show you what happens when the market when everybody piles on board late into a rally that's run into resistance. This is 330 to the button right here where my crosshairs are, almost exactly high within basis points. A basis point is 1/100%. So we came within, overshot it by mere basis points, so almost a perfect hit there. And so far they faded 1.6%. It's been a 1.6% drop. In other words, they faded all today's gains and quite a bit of yesterday's as well. So that's that. And we'll see what happens for going forward, but maintain its objective short entry. And when you look at this, I made a comment. Somebody was feeling some pain on the IWM short, and you got to have your pain threshold, and if your stops are going to be in line either with your price target. In other words, some of you are probably playing long ball now, and some are playing the short game. The long game here is here's our uptrend line. This is a weekly chart, by the way. I jumped over these are my weekly targets from the initial short entries. Well, multiple here, those two breakdowns, every back test of resistance, every back test of the 200 days, and I still maintain these longer term. My next downside target, because remember T3 has already been hit. That's where we reversed. We had a perfect tag of that third target from back in the beginning of the year. And this next target, just to measure it out from today's highs, if you took that short, that's about 29%, so almost 30%. If you were to short today, for example, a 3-to-1 RR risk-reward ratio says if you're targeting 30%, you can allow yourself a 10% stop. However, if you're trading just an active trader and you want to hit some of these near-term, I give you short-term pullback targets and a max current swing target. I know that sounds all confusing. That weekly chart, those are trend targets for a trend trader, active traders, or even if you're a swing trader, even a trend trader. It's pretty nice to game. You want to game a 20% bounce in a bear market rally. Yeah, excuse me there. Yeah, in a bear market rally, it'd be nice to sidestep that on shorts and or turn around and book, trade it long and then get out, or a good part of it. And if you're trading this, this is my max swing target, where if we get down here from that 330 level, that's about, I'm going to just give you a ballpark measurement here. I'll start a little below and go a little below there, about 10.5%. So if you're targeting that, for example, and today was your entry, let's just say, or whatever your average entry, you have to just take that and calculate it in, then you can give yourself a 3-4% stop loss. And that would take you right up to about that 200-day. If they run at the 200-day simple, they're probably going to pop it. That's the norm. It is much more common than not. You don't always get it, but when you run at these 200 days from below, when you're in a bearish trend, you usually will overshoot them at least on an intraday basis, meaning throughout the period they'll close the day on or back below it, and quite often maybe for a couple days there. So a weekly closing basis is really my preference for a trend trader. Above a weekly close, solid weekly close above the 200-day simple moving average again, which is about 3.5 or about 3.5% above. So anyways, so nice fade, like I said, so far. We'll see. Still plenty of work to be done, but as we turn around here, what's going to give us is soon confirmed divergence. So we had the PPO making these lower highs, right? We had one here. We had a divergent high there, and we got a correction, but now we have a larger divergent high. That was our first one there that was confirmed. And now the PPO, if we go much lower, it's going to make a bearish crossover and give him what I call confirmed divergence, because you then effectively put in a lower high over the previous highs there. All right, so let's move on. And here's what I really want to talk to you about. And I've been talking about it quite a bit. And that is first of all, it's getting ahead of this. It's just almost comical. I know smart money, I'm sure a lot of institutional traders are trading on what I'm seeing, and then you talk to the media and they cite, the market rallied, and it goes to show that big rally yesterday that a lot of traders, and many of them probably institutional professional, are acting on what I consider dated and outright, because timing's kind of everything in the market. It's just false CPI reports. A month ago yesterday, when the June numbers came out, I was talking about how they were wrong, and I, faded the Fed fund futures spike, and said it would, you're going to hear a lot about it, that inflation, hottest number in 40-something years, came in super hot, but yet I told you, this is it right here. This box is the beginning of the month. There's the first candle right there of the month of June. So it only went up for about a week and then dropped straight down. Now, how they do the CPI, and I know the Fed uses a different variation, but very similar. They're going to come out around the same over time. They calculate, they get little minions work for the government, go around and buy all these items, goods and services around the country, and it is throughout the month. It's not a spot reading, but what this shows you, this was the biggest drop in years, well over a year, in commodity prices. That was an 18% drop, yet that the markets reacted on this super hot number, and that's all they talked about. And so basically you're seeing here, we got about a 1 month lag. And then what happened yesterday, as expected, because this is now finally, I don't know where they're taking the prices, why it's so lagged, but they reported the July numbers. And then they reported the big drop. The numbers came a lot cooler than expected. The market rallied. But guess what really happened in July is that we had nothing but persistent gains. In fact, one of the biggest rallies in months. This was July 1st, the first trading day. I'm sorry, right there was the first one. That candle right there, July 1st. And we had a weekend, for a 3-day weekend. So the commodities, opened up the next day. But so you had 3 trading days of down and then nothing but up. And so from that low in early July, and if you take an average of these prices, you're going to come up, much closer in the middle there. You saw a gain of about 15% off the initial drop, and net for the month a gain, just like you had net a solid drop the previous month. And yet they reported cooler numbers. So again, here's what's going to happen. All right, so okay, you get the point here. This is probably the best, the most accurate, and the easiest real-time inflation indicator. It's a broad-based basket of commodities, agricultural, food, as well as oil and gas, and metals and everything else. But obviously, it's not counting real estate and other things. But this is these are the biggest inputs, and of course, crude oil. So let's talk about what happened yesterday. And this is that negative, or I'm sorry, positive feedback loop I'm talking about with the market. So markets rally based on people's expectation. The Fed didn't open their mouth; they didn't say anything yesterday, but everyone implies or infers. I'm sorry, they infer that the Fed will then become more dovish or less hawkish. Okay, same difference. You don't have to, just being less hawkish, meaning they're expecting lesser rate cuts, maybe no more 3/4 points, maybe half, maybe a quarter, and they're also talking already. There's a lot of buzz about the Fed starting to lower rates going forward sometime next year. All right, so whatever. Who knows what's going to happen next year? I can just tell you right now, here's the Fed's problem, and this is that positive feedback loop here. And that, the way those work, it's like this, that, the numbers came in cooler, so everyone expects the Fed may let off the gas, but guess what? As I said, the smart money, institutional investors, they bought the commodities hard based on that. We are in, as I've made a very, very clear case in recent videos for last year or so, we are 110% in a bull market in commodities, and we're early in it. We just finished a multi-year, an 8+ year, what was it, longer than that, bear market in commodities that ended when COVID hit back in March of 2020, or when the markets bottomed, and we've been in a bull market. So this was just a bull market correction, and anytime you have the Fed, even just the inference from the general public or the masses that the Fed is going to back off a little bit, inflation is going to just fan. The flames will be fanned again, and flamed again. I'm sorry. Fan the flames. And that's what happened. Look at that. Look at that spike yesterday. So from the previous day, yesterday we jumped up about 2%, and then we're up again 2.8, and this is just a broad-based commodity ETF. Remember, a lot of things move up slower: corn, wheat, soybeans, things like that. We're up 5%. Big green candles. I will say we're at some resistance, so maybe a little check on it here. I'm going to show you crude oil and natural gas. These are your big ones. Energy is the biggest, probably the single biggest, has the single biggest impact on inflation and consumer price index, because it affects everybody from transportation, driving to work, taking vacation, flying a plane, to things that are being built, manufactured. It takes energy to make just about everything, and that energy runs ultimately on fossil fuels, whether it's coal, gas burning plants, coal, natural gas burning plants, coal. And so you can see just here, I'll just pick, this is a 60-minute chart. And it's not as if it wasn't priced in. I told you the other day, time to close out shorts, the most recent swing shorts on crude oil, because we had positive divergence here. And I said the risk reward was no longer favorable to staying short, because we'd shorted here, and that it was favorable to be long. And then when we took back that previous low, that gave us a bear trap, false breakdown, and we've rallied from there. In just been a few days, that's about a 9% spike. Now, crude's at resistance, probably get a little pullback here. If we do, there's 92.60 would be your level to buy back in on a pullback there. But be careful shorting. I'm going to keep things light going forward the next week or so. I'm just going to jump it ahead. Not tomorrow, next Friday early. I leave. I'm running the boat down to the Keys. That's a all-day run in the boat. Well, it's about a 4-hour run, but I'm going to take off through next Wednesday down there fishing and diving. So I'm going to be gone. Very little, if any, posts that Friday. I'll pick things up. When I get back to the hotel at night or whatever, I'll just post anything big next. Again, that's not this coming up week. I'm leaving Friday after next. But I do have to drive my son up. My wife and I are taking him up to move him. He's going freshman and going into college. He got a 7-hour drive, and I'll be gone all weekend moving him in and getting him settled, and that just gives me less time to prepare next week. So I just want to let you know, next week I'm going to be doing a lot of getting ready for the trip, and posts will be light, and so therefore it's also my positioning, but that shouldn't affect you. But it's also summer doldrums. Just keep that in mind. You're going to see some grinding around. All right. So the takeaway is again, commodities have corrected, and with the cooler than expected CPI data, again, even though it was another false print, again, or an erroneous print, because I showed you we had an increase in everything, all things that add to the CPI index in July. And so, again, they are just behind the curve with their reporting, that's all. And again, also, that's that positive feedback loop where if you do get any abatement in inflationary pressures, and there is talks or the actuality of the Fed, either not raising anymore or lowering rates or anything like that, it's going to continue to fan those flames of the commodity world, inflation world. And so just really, if that trend continues, as long as it does continue, let me just say, that's just a complete and utter headwind for the stock market, because every time you're going to see these rallies, and it's going to be checked by the return of inflation again. So this is all lines up with kind of what we had been talking about for the last month or 2 months, as far as a paradigm shift, and everyone's kind of buying in now. Drinking the Kool-Aid, Barron's, the Journal, all yesterday. Headlines raged, all over the place. The Nasdaq has entered a new bull market. They use that antiquated 20% close from the, a gain of 20% on daily closes, and that's what they got yesterday. And again, it doesn't take a master technician to look at the Nasdaq 100 from this long-term chart and say, okay, you want to call that a bull market, call whatever you want. To me, that's just at this point in time nothing more than a bear market rally, just like that one before, that one there, and this one here. And it went up to about where the charts, or at least I figured it would probably go. And no, if it starts doing this and does that, then I'm just outright wrong. But I'm not going to stay short at that point in time. We'll be doing other things. So, anywho, that's the where we're at. And I'm going to show you. I showed you crude oil. I showed you the rip in crude. You can also look at it on USO if you don't have futures charts. You can see this is just the last here. Let me go to a 60-minute chart. Last few days alone, right there, it's up about 10%, and off that recent low, about 11. And then you have natural gas. You can look at UNG, and you can see what happened. This is, you can see the rip here. And of course, you can see there was a nice setup there, positive divergence. There it is, right at support, that $26 support. But let's look at NG, natural gas futures. My preferred trading proxy. There it is. There's that same 60-minute divergent low right here. So again, it's we're doing a combination of here, or at least I am analyzing what's happening and trying to say, hey, don't trade off headlines. I've always said if you trade off news headlines, you're driving. It's like driving looking in the rearview mirror. It's old, dated news by the time you read about it. There are some things that come out and they're not, and it wasn't leaked in advance, and there are some things that surprise the market. But 99% of news that comes out, even earnings beats and misses, it's usually already priced into a stock. Little birdies in the know, I've already traded it accordingly, or it's priced in the charts. And here's natural gas. Again, we're talking about the fact that Wall Street, is cheering. There's been increasing cheers for the whole, the Fed did it. They engineered a soft landing. Inflation's over. And here's natural gas. That is what is that, 20, about almost 27. We'll call it 20. I'm sorry, about a 20% gain right there, just in the last. This is only the 8th. So just a few days ago, 3 days. All right. Now it's at resistance. Is it going to go up forever? No, but I can't make a strong case to short it. I think it'll pull back. You go down to these little 5-minute charts and 10-minute charts. That's my active trading time frame, and we don't even have. It's starting to get a little divergence there. 10-minute. It really wasn't the point of this video. You can trade actively if you want. Crude oil, I know, had a little small divergent high on the short-term time frames and at resistance. So like I said, we'll probably see a little slowdown here, some profit taking soon, but the cat's out of the bag, and the next leg up in the commodities looks like it's underway. And I don't know. I gave you some longer-term targets and crude and all that. Not so sure if they're going to be hit now. Take it day by day. There's a little 5-minute chart on crude oil. So that was when it was at resistance today. It was a little pot shot I took on crude short. And I think it'll come down here a little bit more. It's got a little more downside, and you can see it on the 10 also. Let me show you that. 2-week, 10-minute chart. There it is. There's your divergence, that resistance, and probably pull back somewhere in there, 93 or so, 93 to 92.50 or so. I think is a good pullback target. But again, the bigger move, we'd have to drop under these recent lows to really have inflation to, say that inflation is behind us, that whole inflationary trend. Again, this was just a correction, an ongoing bull market of commodities. And then lumber right up to that flag played out. I told you I just fired off my shares yesterday. I figured there might be more upside, but lumber is number one. It's the main problem. It only trades between 10 a.m. and 4 p.m. or a little after, right after 4. So you don't have overnight like the futures. That's why it gaps a lot. So the best thing to do in lumber is get out while the getting's good. But look, that bull flag I showed you right there, it played out almost to a perfect measured target, which is the distance to the flagpole, and coming back in, and boom, they picked it up right on that first support level. That was a former target on the way up, 50, 575, 50-ish. But again, where am I going with this? There's, other than following up on that trade, look at this. This is lumber, one of a big component, because this is going to affect the housing market and housing prices, which are the other big component of the consumer price index, and 35% gain in just a few days there. So yeah, all right. So I'm giving you real-time inflation data. CNBC is giving you, and the government, BLS is giving you lag data. So if you can look at this, and if you finally were to see commodities breaking down, falling, taking out previous lows, an established trend, downtrend, then you might say, hey, the Fed's done their job. And so, again, the more you get this, that positive feedback loop, it then is going to spill over into the Fed having to get more hawkish, or stay, keep the foot on the accelerator, and that's going to be bearish for equities. All right, last one. I'll just give you an update on Treasury bonds. I've actually done pretty well in the Treasuries lately, trading those. So going back here, it was in June, a couple months ago. I pointed out a bullish engulfing candle. I pointed TYX, which is the yield. I'll show you that in a second, on the 30-year bond at major resistance. And so when yields go down, bonds go up. So I gave you this sold target at the time, 119.84, and then on July 1st, I added this target here when it was hit. So got it out to you. Said, look, I'm adding a target. We're going to get a pullback, probably down a little pullback, and I gave you a pullback target that was hit. Continued on up, then hit that, and I did a follow-up recently. Hit that second target there, and gave you plenty of opportunity to get out. And look at that, ended with a bearish engulfing candle, and then we took out the trend line, the uptrend line, which I highlighted here in the update, back tested, and then boom. So nice move down. Treasuries have been trading well. And yeah, probably more downside, but before we do, we might bounce. I'll show you why. Let's look at ZB. ZB are your Treasury bond futures. So if you're trading Treasuries, and I know most of you don't, I know that because I don't get a lot of comments on these. I just post what I trade. You can take it, not take it. I'm sure some of you guys might trade, or guys or gals might trade Treasuries. But there's the primary uptrend line, same one that was broken on TLT, or similar, I should say. Yeah, 3-month history here, 60-minute chart. There was our time to get out, rising wedge, divergent high, and that's when we hit the major resistance on the daily chart of TLT, which is just the ETF version of this. Came down, hit this level. There's quite a few, a bunch of trades made off there, but when the trend line broke, then the price support below that broke. That was this washout move here today. However, you got some divergence here now. It doesn't have to play out. It's not confirmed divergence, but I'm thinking it can probably do something along these lines. Maybe get a kickback rally to back test, and then continue lower. And I told you I'd show you TYX, which is the yield. So if you're going to trade Treasuries, you need to keep an eye on that. Well, it's all about yields. It's a direct inverse correlation between the yields and the price of bonds. And so this was it. This is a long term chart. This is our secular bear market in interest rates. We're going back from the early 80s when they peaked. That's the yield on the 30-year Treasury. That's why it's been a heck of a stock market for the last 4 decades, 4+ decades. Yeah, four. And I think it's safe to say it's over. It will be once we take out that trend line and we start taking out the previous highs. And this is what happens when the Fed, they thought they could get away with it forever, just being super easy with monetary policy and fiscal stimulus, and then finally inflation reared its ugly head, just like Economics 101 said it would eventually when you print money. What happened back when the financial crisis hit in 08, 07, 08, at least my theory is there was this that it was really known as the debt bubble. A lot of people say a housing crisis was a cause. No, it was a debt bubble everywhere. Credit cards, consumer loans, car loans, and most of that debt just evaporated. Everyone was forgiven on their loans because everybody walked away on their house back then, or a lot of people. I'm speaking metaphorically. Um, the banks were bailed out, so there was a massive just erasing of debt, which kind of offset what would normally been the inflationary effects. So the Fed figured, okay, we can just keep printing money and keep taking rates down, 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 flooding the system with money, and finally they let the genie out of the bottle, and that's inflation, and so they have no choice but to try to fight it. So, anyways, that's so from tactically, this is where, I pointed out when we hit that level that we're not just going to go straight on through there and keep going. We're going to most likely have a reaction pullback, and that's what we did. This is again long-term chart, monthly chart, and so we're back testing there now, and also sooner or later it breaks out. Hard to say when, because it's that whole kind of a positive feedback loop here too with interest rates in the economy. Is that the higher rates go, the more it's going to stifle economic growth, and the more it stifles economic growth, that's going to put a damper on inflation and the economy. I think probably just looking at dead money for years. I mean, I don't, bonds. I've been trading them just tactically inside of 401ks and things like that, where you only have stock, bonds, or cash as your option, and get in, get out, catch some of these trends, and then move on. As far as leaving your money there, it's probably still I've been saying it for a long time, one of the worst investments. And that's what I was harping on back here. And when COVID hit, I said this is unprecedented. For the first time in history, where you have absolutely the institution, the hedge funds are going to get killed because the old 60-40 rule of stocks and bonds mixed, because bonds go up when stocks fall. It's not going to work anymore. Because what the Fed has done with artificial manipulation of rates taken down to zero, there was nowhere but for interest rates to go but up, and that's what's happened. So, and the article just came out recently the other day, how hedge funds, I'm sorry, pension funds, public pension funds like CalPERS actually, they cited that's the largest. They fared okay. But they said only because of their private equity holdings. But the problem is they don't have to report that. Publicly traded securities such as stocks, bonds, mutual funds, they're priced every day, minute by minute. You know what the value is, and a lot of these private equity holdings, they have much more lax reporting requirements. So trust me, they're all down. It was again across the board. The vast majority took big losses and have taken big losses, especially this year as well. And so that's going to be a problem down the road because they were already underfunded to begin with. They've had these unrealistic return expectations, and the outlook for bonds, it's just not favorable. At best, we go into a pretty good recession. Economic growth slows, and there might be a pullback in rates, and then bonds would rally. But then the stock market sucks wind. So it's like a lose-lose scenario longer term, I think, for the financial markets, and that's where swing and trend trading comes in. We can not only avoid, get out of the bonds when we should be out, get out of stocks when we should be out, or turn around and actually profit from it, by shorting those things. That's it. Let me see if there's anything else I wanted to cover. Not much. I'll do an update because I told you yesterday it was time to get out of gold and short it. when it hit my that was GC gold futures 1825 right there, big resistance target from way back here. The final near-term swing target. We hit it, and when we hit it, we had that nice negative divergence, and then we went on to reverse yesterday. Got it out to you right when it was hit. We got nice reversal in gold, and then it went on since then. That's why I'm doing the update. It was can't grab the line or it'll move, so I got to start below and then come a little lower. So it was a roughly, for gold, that's a pretty decent move, about 1.5% drop. And then look what happened. It broke it hit the trend line and danced on it for a while, as it usually will before a final breakdown. Then broke it and then it back tested today. So if you're trading this chart, you could have shorted that and or the back test. And I'll have to sharpen my pencil. I'm going to put a line right here. I think this will probably be your first target if you're swinging it somewhere down around here. I did that because you have a lot of you had support there and a major reaction high there, support there, and yeah, that is a level 1792, but I think 1788 is a more likely initial swing target on the downside. All right, and then I started with the equity markets. I'm just going to end there because right before the video I covered some shorts and reverse just for a bounce. I'm showing you more and more what I'm doing lately, more the active trading stuff. And that is NQ. So NQ, this is a 5-minute chart, one of my favorite. I like the 5 and the 10s for short-term trades. Here's a 10-minute chart. And so you can see that when earlier today, when we hit that 305 level or whatever it was, whatever that level was on QQQ, the resistance level, that was right at the high. We had this nice bearish rising wedge here on the 10-minute chart. And then that was, the short entry posted today, the add-on. We went on to break down below this wedge. We had a little move down through that first support, 13,416, and then went on to back test it from below. And that gave us this little, on the back test, that formed a little bear flag. And then we've gone down and we've almost hit the measured target. We have good support here. If we go down there, I'll probably get a reaction. But remember, we're coming off a pretty good divergent high. So you get these little moves down. I think we'll come down at least by tomorrow down to here. But we may get a kickback first because when you go down to that very, very short-term 5-minute chart, you can see we have a little bit of divergence right here. And here, I'll draw it with my little drawing tool. So you get this at support 13,314-ish right there. Little divergent low, maybe get one more kickback rally, and then the next leg down would be my guess, something like that. And again, that's just active. If you're active trading, probably not bounce very far. I'm going to wrap it up here, get the video out to you, and I think that's all I wanted to cover for now. So if I see anything else today, I'll get one out to you after the close today. Otherwise, we'll pick it up tomorrow. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.